Welcome to this comprehensive and professional guide on the core mechanic of trading. Today you will dissect your move the market and how to read chart like an institution, the foundational concept you are focusing on today is break of structure, known as break of structure. Break of structure is the definitive key that confirms whether a trend will continue. Before diving into the technicality of break of structure, you must understand basic market structure. Price never move in a straight line. It move in a series of continuous wave. In a bullish market, the price constantly create higher high and higher lows. In a bearish market, the price systematically form lower lows and lower high. Understanding this structural swing is the bedrock of smart money concept, or SMC. Retail traders often view price chart as random, chaotic movement of green and red candle. Professional traders view chart as a highly structured map built on structurally pillars. Once you accurately identify three swing, you know exactly where an institutional liquidity rests. A break of structure acts as absolute validation that the dominant order flow remain active. Let us dive deep into the mechanical definition of break of structure and how it print on chart. In a bullish trend, the price pushes aggressively upward before experiencing a natural retracement. The highest point reached before this temporary pullback is designated as the strong swing high. Once the retracement concludes, heavy institutionally buying pressure drive the price upward again. If the market successfully break above that previous swing high, a bullish break of structure occurs. The term break of structure literally signifies that the previous structural ceiling has been completely broken. It is crucial to note that a tree break is not just a weak violation. Professional traders strictly look for a full candle body closer above that price's high. If price merely persists the high white a week and reverses, it is liquidity sweeping. Bullish break of structure prints repeatedly as long as demand control the order flow of asset. Every single time a new break of structure is formed, the preceding swing low become protected. Large institution place their structurally stop loss right below these highly protected lows. Remember, a valid bullish break of structure demands a clean candle body close above the high. This structurally breach give traders the green light to hunt for premium long setup. Now let us reverse our perspective and analyze bearish break of structure mechanic on your chart. In a bearish trend, heavy and institutional selling fully dominate the overall price action. The market drop impulsively to create a new low, then begin a minor upward retracement. Today's lowest point formed before the pullback is the immediate target for market bears. When the temporary retracement and sellers push price down fiercely to break that low, the exact moment price trade past today's low and closes below it, bearish break of strength triggers. A bearish break of structure provide undeniable profit that sellers still maintain massive order flow control, just like the bullish scenario. You require a full candle body close below the low false break made exclusively by long candle wicks are trapped designed to ignore liquidity. Once a bearish break of structure is confirmed, the swing high of that move become protected. Professional utilize these protect swing high to place their invalidation and stop loss level. Trading a bearish break of structure means you are strictly looking for institutional shorting opportunity, aligning your execution white bearish structure keep you safe from sudden volatility market spike. Persistent structural break signify clear capital delivery and break of structure is your visual red map. Next, how do you distinguish valid structural break from everyday market manipulation? A massive mistake among retail traders is drawing a arbitrary line and labeling them break of structure. Rigid real must be satisfied before acknowledging a tradable break of structure. Real number one is momentum. The break must be driven by large displacement candle, tiny instant candle creeping past a level though not indicate institutional intent to expand. Real number two is the close date the candle actually secure its body past strict. If analyzing the for-hour chart, you must patiently wait for that specific candle close. Rushing into trade before the candle closes is why many retail accounts suffer losses. Real number there is identifying a real swing point rather than minor internet market noise. And frequently what looks like a major break of strength is just minor internal structural shifting. Internal structure is highly deceptive and lure traders into trading against the macro trend to ensure high probability setup. Always map your break of structure on higher time frame like H4. When lower time frame structure align white high time frame break of structure maximum edge is achieved. Elite traders combine momentum, body closure and time frame alignment before executing any position. Note that the rare are clear. Late is differential break of structure from change of character. And massive confusion exists within the trading community regarding the difference between these two. Change of character stand for change of character means a foundational shift in market behavior. The core difference is simple. Break of structure represent continuity, whereas change of character represents structural reversal. A break of structure occurs when price breaks structure to continue moving in its current direction. Conversely, a change of character occurs when price fall or to maintain structure and break protected zone. For example, if a market is making bullish structure and suddenly break the last low, that specific violation of the protected law is a change of character, signaling a bear shift. A change of character is the earliest warning that order flow is flipping side. Once a change of character print and the trend reverse, subsequent break are called break of structure. Therefore, change of character happens exactly once at the absolute turning point of a trend. Manuel, a break of structure, y print multiple times at the no trend extend it is run. Knowing this distinction stop you from viewing ultimate high or shorting absolute market lows. In the upcoming minute, you will map this live on real historical chart. Let us transition into drawing this level flawlessly and in covering premium entry model. And now that you can identify a valid break of structure, you cannot just blindly enter the market. Entering immediately after a break of structure form often forces you to buy at the absolute high. Smart money traders utilize the Fibonacci tool to measure the newly formed trading range. This trading range is ensured from the protect swing low to the no swing high, and the 15% equilibrium level divides the structural range into two very distinct pricing zones. Then, anything above the 15% level is considered premium pricing, Y is expensive for beer. Anything below the 15% level is considered discount pricing, Y is cheap for beers. Institutional algorithms are strictly programmed to buy asset only when prices are deeply discounted. As a readily trade following smart money, you must never buy in premium zone, waiting patiently for price to retrace into the discount zone drastically maximize your win rate. In a bearish market, the exact opposite will apply to your structural trading range. You measure from the protect swing high down to the no expansion swing low. You hunt exclusively for short position when the price retraces back up into premium. Let is look at the exact institutional footprint left inside this discount order block. When a break of structure occurs, it level behind specific areas where large orders were filled. The most famous institutional footprint left behind is known as an order block. In a bullish trend, a bullish order block is the last consecutive down close candle. This down close candle represents institutional selling before they heavily pimped the market upward. They must mitigate or break even on those selling positions when price return down. Therefore, that specific candle acts as a powerful magnet for future price retracement. When price mitigate a valid order block, it typically reacts with massive explosive momentum. However, not all order block drawn on your trading chart are graded equal. A high probability order block must be directly responsible for causing a valid break of structure. If an order block fails to break any structure, it is considered weak. It must also rest perfectly within your definite discount zone for bearish setup. Combining break of structure, discount pricing and valid order blocks create a high probability mechanical system. Let us analyze how to draw your execution zone precisely around this block. Next, we will uncover the second vital structural footprint, the fair value gap. The fair value gap when smart money institutions aggressively enter the market, they create immense structural imbalance. And this extreme buying or selling pressure cause because price to move too rapidly forward. This rapid displacement print a specific tail candle pattern called a fair value gap. A fair value gap or fair value gap represent an area where trading was completely inefficient. To find a fair value gap, look at the first and third candle of a sequence. The gap is the empty space between the first candle's wick and third candle's wick. The market algorithm had inefficiency and treat this gap like open vacuum. Price will almost always retrace backward to fill or rebalance this empty space. And fair value gap resting right above or inside an order block is the ultimate confluence. This structural pocket is where institutional order are waiting to get triggered into play. If a break of structure happens without creating an fair value gap, the move lacks three institutional displacement. You look for clean, glaring fair value gaps to map out or precise target entry frame. When price fills the fair value gap, the market structural deliver become fully balanced and healthy. And now let us combine break of structure, order block and fair value gap into a unified strategy. Let us build a crystal clear setup by setup, step by step checklist you can use on every trade. Step 1, identify the macro trend on the daily or forward time frame clearly. Step 2, wait patiently for clean body closed break of structure to print. Step 3, draw your Fibonacci tool from the swing and short point to equilibrium. Step 4, highlight the high probability order block resting inside your discount pricing zone. Step 5, verify if there is an open fair value gap resting nearby. Step 6, set a limit order or wait for lower time frame structure. Confirmation, your stop loss goes safely below the protected structural swing low point X established, and your market and your take profit is placed target at the weak structural high credit before this mechanical checklist completely remove destructive emotion like greed and fear from trading. You are no longer quizzing your market move, you follow systemic rule if any step if any step of the checklist is missing, you simply pass the trade discipline to stick to this exact checklist. Separate losing trade trader from profitable one. No let no let is address the critical concept of multi-time frame structural alignment. Macro with microstructure. One of the most dangerous trap is ignoring the multi-time frame structure matrix. Markets are completely fractal, meaning structure exists instead of larger structural wave endlessly. A single bullish for or wave content an entire daily bearish retracement trend inside. If you only look at the 15-minute chart, you will get easily blinded. You might see a bearish or break of structure on the minute on the M50 and short aggressively today, but in reality you are shorting directly into a major ash for discount zone. The institutional buyer will step in and completely wipe out your short position. Excuse me. To master SMC, you must master the top-down analysis mapping technique properly. Always start by mapping the highest time frame structure of to find your macro base. Label the higher time frame break of structure and look at the higher time frame institutional point. Once price hits the macro zone, drop down to the lower time frame. Look for a lower time frame change of character to confirm the macro shift. This alignment give you the tightest stop loss with massive macro profit target. Let is transition on into real chart example to visualize the factor bullish EER execution. Let us analyze a real world case today on the EER USD currency pair on the 4-hour chart. EER USD was in a clear definite bullish trend. Price pushed up, smashed through the previous strong high and closed body above. You immediately mark this level on our chart as an H4 bullish break of structure. The right above the order block, a massive fair value gap is clearly visible. You now map this entire area as or high probability institutional buy zone instead of blindly placing a limit order. You wait for price to return price beginner to retrace downward, creating lower lows and lower high internal structure. To retail trader, it looks like EREST is crashing into a bearish trend, but to is it is a highly anticipated heatly discount market retracement. Watch closely as price taps directly into the open fair value gap zone. Now let is drop down to the 15-minute chart to exit perfectly time frame execution refined M50. As price hits the H4 buy zone, the M50 chart is currently bearish. The M50 structure is printing clear bearish lower lows and lower high content. You wait for the smart money reverse footprint to print inside or zone. Suddenly bear setup, step in white heavy momentum, printing a massive green candle. This aggressive move break above the very last M50 bear swing high point because this break the counter trend structure you label 10 days and M50 change of character. The change of character confirmed that institutions are officially buying the currency pair. Now you look for the M50 order block responsible for that change of character. You find a small M50 diamond candle white and open micro gap. You place or buy limit order exactly at the open of this block or stop loss is took safely below the newly created stricter swing low. The target is set at the original H4 week swing high. Target price steps or entry flawlessly mitigate the block and expand rapidly upward. This execution model yield an incredible risk to reward ratio of 1 to 5, indicate high and lows indicate. Let us talk about why many traders fail even when applying this concept. The market algorithm built trip called inducement right before major institutional zone. Inducement is a fake structural break designed to trick impatient eager trader early. You will often see a mirror structure break right above a real zone. Retail SMC trader reach to label this break of structure and enter long immediately. They place their stop losses right below this minor in protect structure low. Price then drop suddenly, takes out their stop and taps the real block. The market explicitly engineered liquidity by stopping out those early buyers before expanding to avoid his trap. Always ask yourself, where is the true liquidity resting? If there is an unmitigated order block lower down, expect the current low to fight the low right above a major zone. Is almost always liquidity, not strict. Train your ears to wait for the market to sweep this under. Document patterns to wait for the real structural sweep will skyrocket your performance. Let us look deeper into tracking liquidity pulse alongside structural. The relationship between break of structure and liquidity pulse. Market structure and market liquidity are two sides of the exact same coin. Every single time a break of structure occurs, a massive pool of liquidity is engineered below every protected swing low. Retail traders place thousands of sell stop order above every protected swing high. Buy stop liquidity pools are heavily built up. Smart money institutions require this massive retail liquidity to fail. Their enormous position, their effort, the market move from one major liquidity pool to the next systemic. A big structure is the visual proof that a liquidity pool has been targeted. When price take out a high, it collected the buy stop of short. Once that liquidity is consumed, the market can freely reverse or retrace safely. Never view a break of structure as just a simple line break on your desktop. View it as a major event where billions of dollars changed and instantly. Understanding this prevent you from trading directly into major institutional liquidity trap. You want to trade alongside and strong swing with weak swing. To map structure perfectly, you must know which swing are structurally stable. In a bullish trend, a swing low is considered a strong structural low. Why is it strong? Because it was responsible for breaking a major high. Since it successfully created a break of structure, smart money. Why actively defend this law. Conversely, the swing high in a bullish trend is considered a weak high. Why it weak? Because it fight to hold the market structure down. The market structural objective is to constantly target and break this weak high. Therefore, you never short at a weak high regardless of candle patterns in a bearish trend, and in a therefore you never short at weak high regardless of candle pattern in a bearish trend. The swing high is strong because it caused a break of structure. The bearish swing low is weak because it completely fight to stop, and your profit target should always be placed at the structurally weak point. Your stop losses must always be protected behind this structural strong point. Mastering this mechanical framework simplify your target selection process entirely. Today, let us halfway summarize and prepare for advanced structure mapping next. And welcome the channel, and abonne me and like me in this channel. And this is the best channel for trading forex ICT in 2026. And goodbye, guys.